Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone, and welcome to the Top 5 at 5. I am Catherine Murray, and always pleased to be able to bring you the top minds in investing. Today, we've got Diana Avigdor. She's the head of trading at Barometer Capital. Diana, great to have you with us today. There's certainly a lot going on. Today feels like a bit of a better day in the markets versus what we've been seeing. So thanks for being with us to kind of unpack everything that's going on. And why don't we start with that in terms of just kind of the top-down view that you're observing?
Thanks, Catherine, for having me. Always nice to see you. Yeah, we have a little bit of a better day today. Actually, as a trader, I'm going to put my trading hat on. The betterment in the market kind of started middle of last week, towards the end of last week. We've had quite a challenging year so far, I guess. Markets hate uncertainty. And the way the rates yields, the way the yields rallied in the market from the beginning of the year, the speed with which and the magnitude with which yields went up kind of toppled a lot of correlations. Bond equity portfolios needed to be rebalanced in a particular way. Currencies needed to be rebalanced. It's all interconnected. So it wasn't, I think we spoke in the beginning of the year and I said, we've seen generational lows in rates, and actually we've said this for over a year now. We knew when we were at $17 trillion negative yielding bonds and globally that we're probably seeing generational lows in rates. And so rates needed to go up. And when we came out of COVID and started using services and traveling again and so forth, that created a jump in demand, which pushed up prices, which created inflation. But inflation like this is not bad inflation. Inflation that created because of reopening and growth and demand and consumption at generational low rates, that was a good thing. So rates going up because of that, that's good inflation. What started happening, of course, we had geopolitical issues in China closing down, particularly Russia and Ukraine geopolitical, and that created a situation where commodities started jumping up. And that inflation is not good inflation. That kind of inflation is just a tax on the consumer. So markets started to go into a bit of a funk. And as you know, we're down quite substantially year to date. Last week, early last week, it was maximum negativity. We have very little exposure in the market. Lots of people sold stuff. Portfolios, particularly active portfolios like hedge funds, and commodity traders and volatility traders, those have all gotten out of the market. Price insensitive sellers, and market was at maximum negative sentiment and positioning, and so you knew that it priced in for now the sell-off, and we've been having a couple of better days. We'll see how long this can last. We are running into resistances, but the market could rally maybe 5% before we have to start dealing with seeing how it next leg and where that goes.
Is this just a bear market rally? I mean, that's kind of the comments that are going on today.
I know lots of, again, this feeds into maximum negativity. We at Barometer think that we're still in the secular bull market. A secular bull market can have pretty lengthy periods of correction. We could have a down year, and it may not necessarily mean we're in a secular bear market. We think that there is pockets of strength, and we're monitoring that all the time. We believe that 80% of your return comes from being in the right environment. So being in the right sector. You pick your sector right, and then go into the stocks that you like within that sector, you're okay. You can love a stock, and it could be a great stock, but if it's in the wrong sector, it won't work for as long as the sector is out of favor.
Yeah. Yep.
So commodities, materials, agriculture, they kind of worked when growth was the theme in the beginning of the year. And so at the end of the sell-off, call it last week, they came for the stronger ones, including these ones, because they sold this technology down substantially before that. They came for the stronger ones to sell those down. And now when we look at what's getting better here, it's the same material, it's the same sectors that were strong in the beginning of the year before the geopolitical issues hit. So materials and energy and dividend growth and agriculture and defense. And those are some of the sectors that we favor in our portfolios right now.
Okay. Let's talk about some of the stocks. Speaking of the fertilizers, Nutrien is one of your top picks. Yeah. Why is that? And what's going on with the fertilizers in general?
Yeah. So, so agriculture. So Russia, Ukraine are big suppliers of grain to the world. And given the geopolitical environment, this created uncertainty. As well, we have had unfavorable weather in the U.S., which created a more strenuous environment. So Nutrien is in the right sector. They have two key agriculture segments, potash and nitrogen, which both are under global capacity constraints. So prices are going up, and they're able to benefit from the pricing and create a margin benefit. A lot of companies in this market environment, inflationary, call it, do suffer from or can suffer from margin erosion as prices go up, prices of the inputs, supply bottlenecks, and so forth. So for a company to maintain and increase its margins is something that we'd be looking for, and this company fits that bill.
And so Nutrien is able to increase their prices, but what about their own input costs?
So they they are able to increase production enough to help offset the input costs that increase that they experience, and global capacity still remains tight. So they have more pricing power. You see today Walmart reported.
Yeah.
And they told you that they're seeing margin erosion because they're not able to. They don't have as much pricing power to pass on as some other companies. So you're looking for companies that are able to pass on whatever input cost price increases so that they can maintain or increase their margin. There's enough there that they're able to do that.
Let's take a look at another one. So staying with the fertilizers, right? You've got potash as another top pick.
No, potash is not one. Nutrien, one of their key
is potash.
Is the potash. So
got it. And then
again, markets are extremely tight in that area.
Okay.
And so Nutrien is able to benefit from that perspective as well.
Okay.
Their two key agricultural components is potash and nitrogen.
Right. And you think that I know what I was going to ask you. The stock price. What's reflected in the stock price right now?
What do you mean?
From a valuation perspective, how attractive is it to step in today?
How attractive? Like whether we recommend buying it today?
Yeah.
Yeah. We think that it's poised to go higher. It's not only, you might say, I guess your question could refer to what happens if Russia and Ukraine situation is better.
Mm-hmm.
And with that is a pricing in a geopolitical premium. And so the issue on the geopolitical side is that if there is a betterment in let's say war ends tomorrow, is Russia going to be able to sell their produce in the world? Are sanctions going to go away immediately? And
Right.
the answer is, I think not. I think the world is pretty angry at what's been going on, and I think those sanctions remain. And that, by the way, will apply to energy as well.
Right.
So the world doesn't go back. Something has changed from a global balance perspective with this with Russia and Ukraine situation, where Russia has put itself in a situation where it likely doesn't go back, at least not in the near term. Sanctions remain, and so those stresses that this situation created, both agriculture and energy, are likely to remain.
Okay. Let's take a look at another top pick of yours, TOU.
So Tourmaline, natural gas and, fertilizer, energy, so oil and natural gas, they're all kind of bunched into, I would bunch it into the same idea that this is where you kind of need to be. Be it because of the geopolitical situation, or be it because the economy is growing. And so there's going to be increase in demand from that perspective, which is what supported this sector even before the war started. So Tourmaline, best-in-class gas producer in Canada, extremely strong management team, guided to a special dividend every year. And by the way, in a market that may not be firing on all cylinders, so technology is not acting that great, and it's a big portion and all that. So, there's some fears out there and you're being surgical in your picks. Dividend growth and dividend stability is of paramount importance when you pick your stocks. So margin, sustainability, and increase, dividends, sustainability, debt repayment, strong management team. Those are all the metrics that whatever company you're looking for, as long as it's in the right neighborhood, right sector, those are some of the marks that you should tick off when you choose your stocks. So Tourmaline is one of them. They also had an LNG deal with Cheniere.
Yeah.
Which allows them access to Japan and Korea. You asked what's priced into Nutrien. Well, we think that in Tourmaline's case, this contract is not priced in, and so you have some upside there.
And why isn't it priced in, and what does it really give them? So Tourmaline doing a deal with Cheniere down in the States.
So that gives them access to Korea and Japan market, and for some reason, analysts think that maybe there's not enough upside bump in there, but we think that there is.
One would think there would be, especially to be able to partner with Cheniere.
Yeah.
Okay. One question as well, when you talk about liking companies right now with dividends and dividend growth, which I agree, just given all the uncertainty, it's nice to know that I'm going to get paid something for holding the risk of stocks, which, are obviously very volatile. But at the same time, when you have a rising rate environment, dividend stocks tend not to perform as well, or at least that's the theory.
So, we don't need to maximize value. We need to have value. And you need to balance. So what you're saying, I don't disagree with it at all. But you need some stability if you fear that there is a little bit of a bumpy road ahead as the market adjusts to a higher rate environment. So the question, so going back to the beginning of our conversation, the market doesn't like instability. market can price in everything as long as it knows what is the case. In the case of what's going on right now, and inflation, we all know so in the US, it's about 8%, which is high. Everybody knows that it's going to taper off because the bulls are saying, oh, inflation is coming off. Why are rates going up so much? Everybody knows that this is bottlenecks, and the bottlenecks will balance out and inflation is going to come down. That's not the question. The question is what the terminal rate of inflation is, what the sticky inflation is, what sticks, what doesn't go back. And so if you're looking for inflation, if the Feds are looking for inflation at 2.5%, if sticky inflation is at 5%, then the Fed can't stop raising rates. And Canada won't stop raising rates either. And so then it brings us to what is the terminal rate of interest rates? Where will we end?
Yeah.
And so and this is what this is why the market's doing what it's doing. These are the unknowns right now. And so as it's pricing in higher band of inflation and rate and the lower band of inflation and rate, it doesn't know. It just sloshes around in this range right now until more data comes in, more earnings reports come out. The geopolitical premium might hopefully be taken out of the market, and then where does it stabilize? So in this moving environment, dividend stability,
yeah,
and growth is not a bad thing to have, even if, and not all your portfolios in one thing. Hopefully you are diversified and you have some companies that are maybe smaller cap and a little more risky and a little more torque. Then you have companies that are more stable, creating yourself a little bit of an anchor in the portfolio so it doesn't have kind of upside and downside volatility that perhaps you can't stomach.
Yeah, fair point.
There is room for that kind of
yeah,
thing.
there's room for it. Yeah, no, I agree. It is nice to actually have. I've been adding dividend stocks for quite some time now, just for the long term. I actually bought, not to segue here, but I did buy some of the REITs with right during COVID, like smart centers, when I could get like an 8% yield, and automotive property REITs. Yeah.
That's fantastic.
Even Exxon.
Exxon
I have like an 8% yield on.
Which one?
Exxon.
Somebody that always picks growth stocks picked Exxon today as part of their recommended portfolio.
Yeah.
Great relative strength.
Yeah, I think I bought it. I bought it about a year and a half ago, 2 years ago, something like that.
You're good.
Lucky. Somebody had been telling me about it to look at it for 2 years. And I was just looking, waiting. But to your point about sectors and when sectors work.
Yeah.
That's kind of when I started to see the sector start to work, energy. So
yeah. But 80%, studies have shown that 80% of a portfolio return comes from being in the right sector.
Unbelievable.
You can be, Apple could be a fantastic stock, but it's still off. And it was the last one to be sold because it was a store of value. And Apple is not going anywhere. And it has a huge balance sheet in the buyback. And it's going to be a good long-term stock.
Yeah.
But it's just out of favor.
Yeah. Speaking of which, do you think tech gets back in favor? We're not talking about tech today, but you've been involved in tech for years.
Yeah. So technicals matter.
Technicals of technology stocks matter.
Technicals of everything matters. A good stock should have a price behavior that reflects its goodness. If you think a stock is good and the price is at a 52-week low, you got to scratch your head and ask yourself, why is the price action not reflecting what you think in the stock's or company's excellence? And find a reason. And if you're okay with the reason, be it the market's not giving it credit for something, or you have to find a reason. If you don't know why a stock is trading at a low when you think it's so fantastic, you gotta ask yourself why.
Yeah.
So technical analysis matters because it kind of tells you what the stock price action is and where it might pause and what it needs to do. Not like you buy stocks because of the technicals, but it needs to confirm, and you need to know where to watch out for and see behavior. So technology stocks have really sold down hard. And so technically, the moving averages, which kind of what we use as main inputs to technical analysis, are coming up from above and they're downward sloping. And the stocks are coming from the bottom to hit these resistance levels. And there is a good portion, because they've been sold down so hard, so they could rally. Let's just talk index, because the individual stocks could do more or less. But let's say NASDAQ could rally 5% and still look bad.
Right.
So there is some room for deeply oversold stuff. And I don't know if you've been following Kathy Wood's ARC ETF. That's stuff. It's off, I don't know, 70% from highs this year. She actually had flows in, like you can follow last week. People were really loving the fact that she didn't steer away from her mandate, that she stuck to her guns. And so I guess if you have 100% of your portfolio and you want to put 5% in something, it's good to know that your manager is not moving from what you're getting. Anyway, there's been some cash inflows, rare cash inflows into that fund last week. So people are trying to pick bottoms a little bit.
Yeah. Bit of a healthy
There
sign.
could be a bit of tech rally.
Yeah.
But it's still pretty.
A lot of damage in there. Yeah. Let's take a look at your next topic. Enbridge, ENB.
Enbridge. So we were talking about the merits of stability.
Yeah.
In the market environment that what we've had, stable defensive utility, anchors your portfolio, focused on paying down debt, share buyback. We have a counterparty risk for Enbridge has decreased. They strengthened their balance sheet. By the way, oil and gas sector balance sheets in general have been getting much better, and good cash levels. So balance sheet stability is important there. And really, there's nothing sexy about Enbridge. It's just good, stable dividend, shareholder payback. Stock that you need in the market environment that, markets are off, 20% off highs constitute bear markets. Again, we think we'll see if we enter a prolonged bear market. But certainly in a secular bull market, we could have a year that is not so great. We've had a very great run.
Yeah, we've had a great run.
You have to be surgical.
You have to be surgical. Yeah, surgical in your approach for sure. And your last one, just in the interest of time, in the defense sector.
Lockheed Martin, defense. Again, let's talk about the neighborhood. There isn't a country in the world that is now cutting defense budgets. Right? Defense budgets are at least going to be stable, if not growing. There's no electorate that is opposed to their government raising defense budgets. So that's not an impediment. Lockheed Martin, as are some other defense companies, stable, visible revenue. Their contracts are long in nature.
What are the valuations like?
I'd have to look up exactly what the.
Okay. I'm just wondering, how much damage has been done to some of the defense stocks.
Yeah. So, and by the way, valuation, this correction in the market is a good cleansing. Yeah. Valuation perspectives. Sometimes bear markets give you opportunities, and at least cleanses some of the valuation excesses.
It's down about 6% just over the past month, up by about 24% on a year-to-date basis, but down 6% so it's come off about 6%.
Oh, it's trading at 16.5 P.
That's not bad at all.
It's 13.5, but forward P is 16.5, not bad at all.
And
And
2.5%.
it's trading at a price, what we call PEG, price to growth of 2.6. Gross yield 2.5%.
Yeah.
5-year dividend growth of 10%.
Wow. That's
And
nice.
so it's not, I'm just looking at the Bloomberg screen here.
And Diana, why Lockheed over some of the other defense companies?
You gotta pick one. They're all, if I look at Northrop Grumman, for example, is trading, it's more expensive. Their gross yield is lower. So I think the chart looks pretty much the same.
Okay. Okay. All right. Dana, we will wrap it up. I guess any parting words just in terms of the volatility that we're seeing in the market?
So we have 15% cash. That's pretty high for us.
Wow.
I think as a word of advice to people, being a disciplined seller, being a good seller is very, very important. If your stocks break down, don't keep them hoping they'll go back up. Sell your losers first. Keep your winners. Otherwise, you'll be left with a portfolio of losers because you've sold all your winners. So, that's what got us to the 15% cash. As the markets were selling off, and relative to the market, our portfolios have done very well. I mean, we're barely down a couple of percent or so. In the market that's down a lot. And, we loved technology. We were high technology, and we would have stayed with our weight of past times without being disciplined sellers. We would have ended up down a lot given what happened in the tech market, but we had no tech. Actually, our long shorts funds actually went short some of the tech stuff and made some money on it. But being a disciplined seller is of paramount importance, almost as much, if not more, as picking the right stock. Because again, if you go to the right sector, then even if you don't pick the right stock, maybe you get lucky. But with selling, and when the market sells off and you're not disciplined enough, you can take quite a haircut. So watch your stocks, watch your pricing. We think pricing should go with what you think about the stock. The stock is not acting well. Ask yourself why, and why you should still love it. If not, take your small losses.
Okay. All right, Diana, we'll leave it there. Thank you so much.
Thanks, Catherine, for having me again. Good seeing you.
Thank you. Good to see you.
Take care.